Okay, so thank you all for joining us for another Opus Connect webinar series. Today we'll be discussing the availability of capital to independent sponsors on new deals. Definitely looking forward to getting into that discussion, but before we do, as usual, we have a few housekeeping things to get through. So as we shift to the next slide, Opus Connect. For those who don't know me, my name is Lena Dobrier. I'm the Director of Operations with Opus Connect. We are a lower middle and middle market M&A focused organization. We have chapters in LA, Chicago, and New York, where we do monthly seminars. And in addition to those events, we do deal sourcing events, typically all around the nation in 15, 16 different markets, as well as Canada. So if you're interested in learning a little bit more about us, please reach out to my colleague, Jacob Zeffrin. His contact information is below there, and he'll be happy to answer any questions you might have. Moving on, there is a Q&A box at the bottom of your screens. This will allow all of you as audience members to pose live questions to our panelists. So please do that as things come to mind. We'll be taking live Q&A and kind of weave those into the discussion as our moderators see fit. So bottom of the screen, Q&A box, you can type in your questions there and we'll try to get to as many as possible. Before we begin, these events would not be possible without the support of our sponsors. So I want to give each of them an opportunity to introduce themselves, starting with KLR. John, let me see if I see you here. There we are. Please introduce yourself and your firm, John.
Thank you, Lena. Hello, everyone. My name is John Surratt. I'm a partner at KLR. KLR is a large regional public accounting firm. We have 250 plus people across 4 offices in Rhode Island and Massachusetts. I head our private equity venture capital services group, where we're working with middle market and lower middle market, private equity and venture capital firms, as well as independent sponsors on their firm and fund needs, as well as their portfolio company needs, including audit, tax, advisory, and transaction advisory services, including due diligence, both financial, tax, and IT related. Look forward to seeing you all later on. Appreciate the opportunity to host, to sponsor rather. Thank you.
Thank you, John. Next, we have Abb Insurance. Matt, I see you in here. Please introduce yourself and your firm.
Thank you. Yeah, my name is Matt Soma. I am Vice President of Transaction Risk at ABD. ABD is an insurance and financial broker. I place what's known as reps and warranties insurance for ABD. Reps and warranties insurance is an insurance product that is used on most middle market M&A transactions today. So I place reps and warranties, tax insurance, contingent liability, and reps and warranties on distressed deals. I'm a former M&A lawyer, and I'm now on this side of the M&A business. Thank you for having me, Opus. Thank you for the opportunity to host.
Thank you, Matt. Moving right along, our next sponsor is Focus Search Partners. Steve Finder, I see you. Please introduce yourself and your firm.
Hi, thanks, Lena. I'm Steve Finder. I'm a managing director with Focus Search Partners, a retained executive search firm. We've got 9 offices across the U.S. and a large parent company. We're particularly good at helping portfolio companies, private equity-backed portfolio companies, in terms of revenue generation, whether it's go-to-market executives, building out advisory boards to help them open up doors, or working with within the CEO, CFO, and engineering arenas. We cover technology, healthcare, industrial, and consumer. Most of us that are in the partner level have operating experience, so we come at this from a little bit of a different angle. And just pleased to be here today, and thanks for including us.
Thank you so much, Steve. Next is Resourcive, and I don't know if I see Nick in the audience. If anyone is here from Resourcive, there's a button at the bottom of your screen next to the Q&A called Raise Hand. Please do that, and we will come back to you if I see that pop up. But moving on to the next is 4 Degrees, Abb. Let's see, are you in here? I don't believe I see you either. Another new sponsor. We appreciate your support. And again, we'll move to you if we see you pop in here. But As we move to the next two sponsors are both panelists and our host, Frisch Capital. I'll allow Drew to introduce himself and his firm once we get to him as a panelist. And then next we have Burns and Levinson, who are our hosts today and our moderators, and we would be in their office were it not for the current situation, but we are grateful to you to open your office when we are, and happy to have you here today. So before we begin, we have two poll questions that we want to ask the audience. This is a great way for us to gauge how you heard about today's event and also who's in the audience. So we're going to pop those up on your screen now. Please answer, and we'll get those live results, and then we'll move to the next one, and then we will begin. We'll give everyone another 10 seconds or so. A lot of you heard about the event through us and our speakers and our sponsors, so we appreciate your support in helping us to promote today's event. Let's end that one. Great, cool, helpful for us to know. We'll move to the next question here, which is, which best describes you? Are you an independent sponsor, an investment banker? Are you the debt or equity side of capital provider? So go ahead and mark your answers there, and we'll see what we come up with. This is not only helpful for us internally, but great for our panelists to understand who they're speaking to today. Awesome. So lots of independent sponsors, probably tied to our Deal Connect meetings next. We have some bankers, capital providers, a few service providers. So thank you for participating in that. Our panelists will take note as we move into the discussion. And without further ado, I would like to introduce Frank from Burns and Levinson. Frank, I'm gonna bow out now and hand it over to you, sir. You're muted, so make sure you, there we go, perfect.
I'm a great M&A lawyer, but a terrible technician. So good afternoon, everybody. On behalf of my partner, Joe Volman, and I just want to welcome you to our virtual D&L offices. The irony of it is that Joe and I made a major move and opened new offices about 8 months ago. And we have nobody to show them off to, but hopefully in time that will change. Just briefly on B&L, we consider ourselves a premier middle market M&A full service law firm doing transactions nationally and internationally. We're pretty industry agnostic, and we can handle deals from a few $1 million add-on to $1 billion transaction. Joe and I head up private equity, business law, restructuring, finance, all areas which fit into getting deals structured. And we also are on both sides of the table with respect to capital providers, independent sponsors, large, small private equity firms. So we bring a lot of resources to the table. And in this new environment, we've done a lot of restructurings over the years, and we're seeing those kind of opportunities as well. So we're excited to join you today with our great panelists, and I'll let Joe lead in on that.
Great, thanks, Frank. So great to be here with all of you. Great to see so many friends and clients and capital sources that we work with here today to hear our great panelists on a really interesting topic. Obviously, if we had this panel not more than 2 months ago, we were all, I think, going gangbusters in January and February. We were fortunate enough to close deals literally first week in March, just before things changed dramatically. I mean, it just really proves the adage that time does kill all deals. So it's a different landscape. Our topic is a really interesting topic now, talking about the availability of capital, independent sponsors on new deals. And we're going to talk about what that means in this new era of new deals. So why don't we go down the line, and we'll start by having our panelists introduce themselves, and then we can get into the topic. So Chris, you want to lead us off?
Sure. Thanks, thanks, Joe and Frank. Thank you both for sponsoring today, and thanks everybody for tuning in. My name is Chris Sheeren. I'm with Longhouse Partners. We are an independent sponsor based in Detroit, and if you hear a loud boom here, today's our day for the Blue Angels flyover. So hopefully not while I'm talking. But Longhouse has been around for a little under 2 years. My partner, Nick Barker, and I both spent 12 or 13 years at Huron Capital here in Detroit, where I got to know a lot of you. Nick and I both worked elsewhere prior to that, but hung our own shingle in 2018. We are, generally speaking, investing in companies with between 2 and 10 million of EBITDA across business services, consumer, and niche manufacturing. We've made 2 investments thus far and are actively looking for number 3. Thanks again for having me today.
Great, thanks, Chris. How about Brett? You go next.
Hi, good. Still morning for most people, almost afternoon. Founder and CEO of Star Mountain Capital. This is our 11th year of operations. We invest into the U.S. lower middle market exclusively across a number of verticals. We have private debt investing funds. We have private equity investing funds. We have a fund of funds. And then lastly, we have a secondary fund where we can provide early liquidity to people in individual deals or in their limited partnership investments in funds. From an independent sponsor landscape where a lot of independent sponsors like us, we have the capabilities to provide the entire capital structure of a deal. We invest generally between $7.5 million and $100 million per deal, and invest around $500 million a year into the U.S. lower middle market across our strategies.
Great, Drew.
Hey guys, Drew Brantley here with Frisch Capital Partners. Frisch Capital, we're a boutique investment bank since the mid-90s, over 23 years now. We've been raising debt and equity for today what's known as independent sponsors. And so we really pride ourselves in being a great partner to really help you more efficiently as independent sponsors focus on due diligence, managing the seller pipeline of acquisitions, and kind of taking that heavy lifting of the capital raise off of your shoulders and managing that process for you. So we'd love to talk to folks that have active deals, that are looking at stuff in the future and looking to be a more efficient team going forward to get their deals closed. Thanks, Joe.
That's great. Thanks, Drew. And Stefan.
Hi, I'm Stefan Okhuysen. I'm a principal at CVF Capital Partners. We're a lower middle market mezz and equity group. We're actually an SBIC. We're in the $2 to $10 million EBITDA range. We're pretty industry agnostic. We have 3 offices based mostly in the West Coast. I'm based in San Diego. Our main office is in the Sacramento area. And then we have another office in Portland, Oregon. We do quite a bit of work with independent sponsors, and I'm excited about being here. So thanks everyone for participating.
Great, thanks. What a great group of panelists. As you see, we have a good broad array of sponsor, a banker, capital providers. So Frank, you want to start us off with the first question?
Yeah, sure. One thing that Joe referenced is that most people were off to a fantastic year before we all got hit with this pandemic. We were seeing a lot of M&A activity. Companies were crushing it. And I guess before we talk about post-COVID, maybe each of you can talk about how you were experiencing as independent sponsors. And, before we get into what everyone's calling the new normal, I like to call it the temporary abnormal. I'd rather be optimistic. But what you were seeing in the first quarter and what has happened with deals that didn't close in the first quarter. Where are you with those deals? What have you seen with respect to drop off, or are they in the queue, or are you now reapproaching those deals, which I assume you are, and deals are just getting renegotiated because of the environment? So if we could start off there, I think that would give us some insight as to where we're headed into the post-COVID situation.
Happy to take.
Yeah, go ahead.
Happy to take that first if you want. I think it's a wide spectrum for us. Businesses that are in end industries that we remain comfortable with in this current market environment, we have closed. So over the past couple months, the half a dozen or so deals that we've closed have been largely add-on acquisitions or additional growth financing for existing portfolio companies. Other deals that were new investments for us, it's been a spectrum. Some of them we almost got there on, and kind of terms didn't quite match, and they've now come back. So that's been positive, and hopefully we'll sign another deal up under exclusivity today that now kind of fits in the proposed capital structure that we had, which was perhaps a little bit more conservative from a leverage standpoint and so forth. And so I think that benefits people to stay around the hoop in deals and maintain good relationships, and say doesn't fit in a polite way. Other deals that we have, there's some that have uncertainty as far as what the, I guess, swoosh, as people are referring to it now, potential economic recovery will look like in a Nike symbol, and whether the deal still makes sense as structured or not on that front. So we have some deals that legal and everything is done on, and we're hoping that we continue to get more insight into recovery around the industry to make the investment. And then lastly, for us, there aren't many investments we've had completely go away. Deals that we had been moving forward on, we've either sort of paused them or closed them. But I think we're being, much more cautious, certainly right now, if industries have headwinds, which are quite a few industries.
For us, it's been kind of a process, actually. First, we started seeing, disruptions in the supply chain early in the year with the whole China situation. So we started taking a cautious approach. We were looking at a number of deals. We actually still have one under LOI. We just decided to pause it for now. It's in an industry that has been impacted, but we think it's going to rebound very nicely. It's just all the stakeholders, we agreed that it would be better for us just to hold off a little bit and see how things start opening up and the company starts reacting. So we have a number of deals in the pipeline. We're just taking things slowly, seeing how things are advancing, and we're sure we'll start getting a lot more activity in the next couple of months. But it's been a cautious process for us.
So just to kind of, I would agree with everything that was just said. I think the other things that we've seen is that really the last 6-8 weeks, everybody focused on getting companies the resources they need. If they weren't affected by the affiliation rules, the PPP, if they needed that, or, resources, whether it was capital or, a sounding board or whatever it was to kind of, put the fires out or manage the fires as best as possible. We're seeing really now a shift where the portfolio companies, kind of what has needed to be done has been done, and it's kind of a monitoring or the plan is in place to kind of manage the portfolio companies to date. And so we're starting, May 1st was kind of a big date in our mind where we began to see much more of a shift to, okay, now from a capital provider perspective, we're ready to start looking at deals again. If we kind of put stuff on pause, I think for us, we've got a deal that we're taking out and launching this week, and potentially another one next week. So we're starting to see that shift to, folks being ready to deploy capital, which I think for independent sponsors bodes really well because, a lot of independent sponsors that we've been in conversations with have taken the last kind of 8 weeks to put some deals together, to build relationships with companies. And a lot of them have done a lot of legwork so that as the markets begin to open up and money begins to move again for new deals, they're going to be in a good position. And we're starting to see that happen. Obviously, kind of the big question mark is kind of the macro question around what happens with this thing and the bigger the economy. Do we find a antiviral or a vaccine, et cetera? But we're starting to see movement again within the last week and a half for new deals.
I'll add one other thing. So we are now 2 months into this. As I look at the calendar, we had a deal that we were pursuing back in February, March, and just looking at my notes, we submitted an LOI on March 10th, which recall March 11th was the day basically the world started changing for real, or the U.S. started changing for real. That was 11th was the date the NBA announced they were canceling the season. A whole bunch of other stuff. So just kind of adorably naive how we were on March 10th. We issued this LOI. We didn't end up. They ended up signing an LOI with a group that was apparently local. Company was in Florida. They signed an LOI with a local group. And as of a couple weeks ago, I checked in with the team, and they were apparently marching ahead, looking to close by the end of May. So, God bless them. That deal is moving forward. We had a couple others. One, we were trying to get a management visit set up. That management visit still hasn't happened. That deal has been crawling. And we're a two-person shop, so we don't have a huge, data set. But talking to one of my investment banker friends a few weeks ago, they had 25 deals in their shop, which in normal times, he said they all would have been kind of actively in market. And they had 2 of those deals that were active, and 23 had been put in the shelf. So that was 3 or 4 weeks ago. I would say, we didn't see kind of what Drew was saying. I think right out of the gates in March, people were really kind of focused on the portfolio. We saw almost no deal flow in March. And then the last couple of weeks, things had picked up a little bit. We're still scratching our heads in terms of some of the deals that we see. When we saw a deal that did about 6 or 6.5 million of EBITDA last year. They're projecting to do 0 this year and 8 million next year. And so we can't for the life of us figure out why they're in the market. It's just, really banking hard on a heavy COVID EBITDA adjustment. But so that's not a deal we can get comfortable with. But there's others that are interesting. And it feels like, I think to Drew's point, it feels like in the last, I don't know if it's since the calendar flipped or what to May, but last week or two, we're starting to see a little bit more activity.
Well, you're actually addressing some of the questions Joe and I are going to be asking the panels about. How are you getting those deals done with forward EBITDA, trailing EBITDA, historical? I mean, what's the new underwriting? But just one quick follow-up question, I'll turn it over to Joe, is how have you seen your financial sources, particularly your debt, your institutional finance companies reacting to deals that you had in the pipeline? I assume that created some negative fallout on some of these deals as well.
We personally haven't had anything. We don't have anything actively that we're raising capital for. So I'd probably punt to Drew on that answer. He's probably got the best perspective of any of us.
Yeah, so appreciate it. Thanks. Yeah, we have been in conversations with a lot of different lenders over the past, call it, I would say 8 weeks, kind of getting a gauge on where people are. People are still actively looking for stuff. I think the traditional banks have been focused a lot on the PPP capital and a lot of their resources kind of going there and then managing portfolio companies. Unitranche lenders, we see out are still actively, putting money to work or looking for ways to put money to work. We're seeing leverage maybe come down a little bit, whereas, I'm going to call it round numbers, maybe a turn less than what they would have done, the end of 19, people getting a little more comfortable with a little less leverage versus more. I'd say in the short term, we'll kind of see how this thing plays out long term. I think on the unitranche end as well, maybe pricing going up just a little bit to account for a little bit of risk. And then on the ABL side of stuff, if deals, fall into that category, that world has been moving, I would say, really well. I think, Accord Financial is somebody that we know really well, and they were on a panel last week with us, and Lily was, talking about how much they have been continuing to do, but obviously being more selective. So, and also thinking about how much are they going to give folks from an asset valuation perspective. So, I would say lenders are definitely still out there, and there's a lot. A double who, if you weren't on the one last week, I would encourage you to watch. I'll put a plug out there for during the intermission around 3:00. There's going to be some presentations, and a double shows this slide about the amount of capital in the marketplace today compared to 0809, and it actually goes back like 15, 20 years. So it's a really interesting chart. And one of the things that he highlights on there is that the private debt markets are, I want to say it's like 3 times, 4 times larger than it was even 10, 12 years ago. And so, to me, that that highlights the availability of a significant amount of debt, whether it's coming from traditional lenders, or private debt funds, the unitranche market. I think there's a lot of debt out there that's still being looked to put to work, but I'll throw it to somebody else now.
Maybe one counterpoint to keep in mind with Drew's point, that's probably a bit of a balance, is that the amount of capital in debt that has pulled out of banks in that same time period may be even larger or similar. So some of the data is challenging because the banks have really, used to have some mid-sized commercial banks that would do some more cash flow, stretch lending type of stuff prior to the last recession, which have, for the most part, gotten rid of that. The odd bank has come back a little bit, but a lot of folks that used to have pretty substantial divisions in that have retracted a lot. And the other thing I think will be interesting to observe, and I don't think we'll really see its impact until around July, until Q2 numbers come out, the BDC capital, right? BDCs compared to the last recession were a few $1 billion, and now there's about $150 billion. The CLO market prior to the last recession was about $350 billion. It's now over $700 billion, I think $850 billion. So these are big dollars, but they're all pretty highly levered, depending on the BDC. Certainly CLOs all are, and BDCs depend on the one. It'll be interesting to observe their leverage providers when they have some probably pretty substantial covenant breaches and fallout of borrowing bases come Q2 numbers end of July. Whether that's going to halt a lot of them from lending will be an interesting situation, and how they might have to deal with business owners, which I think is something, depending on how people play in this sandbox, creates either challenges or opportunities for you. So that'll be an interesting observation, I think, coming down the pike.
I think it's a really good point, Brett. Good, thanks for bringing that up.
But the one that's pretty safe, though, is private equity capital, right? The amount of dry powder in private equity, it's not levered. It doesn't have constraints. It's generally got 5-year, drawdown periods, and there's a tremendous amount of dry powder there that's definitely dramatically different. And it'll also be interesting to see if that keeps valuations up. You see it in the public markets of it today, which a lot of people scratch their heads at, but that's largely an influence of just massive monetary stimulus. Will that happen in the private equity markets, or will we all see valuations come down and be better, better from a valuation perspective? So I'm certainly curious to observe how that plays out.
Yeah, if I can just add that what Joe and I have seen the last 60 days was the first initial wave of the forbearance and the modifications. We're projecting a significant wave in the fall, another wave, because those deals are going to come up. And that there was clearly, for obvious reasons, a retrenchment in capital. We're seeing we do a lot of ABL, unitranche lending for finance companies and banks, and we're seeing that starting to free up a little. But there's no question, there's going to be a lot of workouts in the fall. And to mention, to follow up on your point about the private equity, what we're seeing with some of our private equity clients is actually a move towards the distressed part of the spectrum, and actually starting to buy debt to get loan to own deals. So people are definitely pivoting. There is a lot of private equity dry powder that hasn't gone down. If anything, a lot of people closed on major funds before the pandemic, and they're sitting on a ton of capital. And you just might see more equity be put into deals, which would delever, obviously, the institutional side. So, Joe, I'm going to turn it over to you.
Yeah, I just wanted to add, I would echo everything that I heard, but as an SBIC, we have 25 plus banks that are investors in our fund, and we talk constantly with them, giving them updates on how our portfolio is going, and also to get feedback on how the banking world is seeing the market. And we have heard that the banking world has pulled back a little bit. They're being obviously way more conscious, looking to do more ABL. Looking for good asset coverage, and a lot of those airballs that they were doing, a couple of months ago in industries that seem to be pretty safe industries are obviously pulling back on those. And so, yeah, I agree. Private equity is probably going to be way more active in the market. There's a lot of private equity money out there, and so, yeah.
Great. So first of all, thank you to Calvin, who sent in a question in our Q&A, and we'll get to that in a minute. Let me switch gears for a minute to go to our next question, but then we'll get to, and if you have other questions, those in the audience, please send in other Q&A. We'll get to those for sure. We talked about deals in the pipe that were in the pipeline. Let's talk a little about new deals. So Drew, I'm glad to hear that you're seeing a lot of activity. You're going to come out with a deal soon and another one, and sounds like others are looking at signing LOIs. I know, Chris, you mentioned the hard part is getting out to see management. I've heard from investors and from buyers that they're hesitant to do the new deal because these Zoom meetings are great, but they still want to get to see management in person and kick the tires and so forth. So the real question is, how are you all looking at new deals, and how do you think you're going to get a new deal done in this era? And what would it take in terms of timing and availability of things for you to be able to sort of get a deal over the finish line?
I guess I'll start. It's a great question, and we're wrestling with a little bit. We're big kind of relationship people, and really, it's important for us to really kind of get to know who we're partnering with over the next 5 years, and for us, that traditionally has come from literally breaking bread with people, having dinner and lunches and a drink and whatever, and really getting to know people and what makes them tick. And so not being able to do that is just kind of it's just kind of a new world for us. We had our very first management visit via Zoom last week, and it was fine. It was a little glitchy here and there, but you get through that. But I was talking to the investment banker afterwards, and he said, or a couple of days afterwards, and we were talking about this very concept. Could we get to an LOI and a closing without having met? And he said, my client's saying the same thing. They just feel weird about. And everybody on this call, we do this kind of thing all the time, but for these guys, this is a once or twice in a lifetime experience, and they're struggling with the notion of can I sign an LOI with a group I've never met face to face? So it's weird, but I think the answer is we're probably going to have to, if we want to get a deal done in the next 6, 9, 12 months, barring some miraculous vaccine coming out of the woodwork here sooner than later. So some of us, I have a daughter who's immunocompromised, and so traveling for me is going to be a real challenge for a number of months. And there's a lot of people, I'm sure, that are in my shoes. So I think I think it's going to happen that LOIs get signed and deals get done without actually a personal handshake, which again is just for me. I haven't been in this business for 25 years. It seems bizarre, but I don't see any way around it.
Well, Dr. Fauci says there will no longer be handshakes anyway, so you can forget about it.
He's wrong, but okay.
For us, it's been kind of the similar type of reaction. It's hard talking with management teams online, not being able to meet with them in person. In terms of what we're trying to do, I mean, we have seen a steep reduction in the number of deals we've seen. Actually, most of the most recent deals we've seen have come from independent sponsors. Typically, we see 10 to 15% of our deal flow from independent sponsors. That has ticked up closer to 40%. I think we're also going to shift a little bit the way we've been deploying capital. We've been doing a lot of buyouts and supporting a lot of independent sponsor transactions where we are the majority or control equity. That's probably going to shift a little bit going forward. We're probably going to be doing more recaps and just supporting strong companies just with a weak balance sheet, because the name of the game is going to be helping companies getting out of trouble with banks. And we think we can support companies in those type of situations.
So last week I was on one of these meetings, and there was about half a dozen capital providers, all equity or debt and equity. And there was two people out of the group that were willing to close deals without actually going to meet and break bread. They were, they're actively, both of those private equity groups sitting on capital. They want to put money to work, and in their mind, they see that as a competitive advantage to be able to move quickly in a time like this for things that they really like. The other four, they all said it's what they're debating, in their investment committee meetings right now is can they do it? And I would say two of them were kind of 50-50. The group was kind of split. And I think one of them indicated that they're probably going to lean towards, if the deal is right, they'll be willing to do it. You know, and then a couple of them said, you know, it's just a core part of who we are. And so if we can't break bread, you know, it's going to be really tough for us to close. So I definitely think that the world's divided. I'd be curious, you know, what Brett's take is over at Star Mountain and how you guys are thinking about it.
Yeah, thanks, Drew, and agree with Stefan's point as well, as far as thinking about use of proceeds and what this type of an economic environment really brings for a lot of businesses, not just the real estate industry or something like this, but this pandemic has been so far reaching across so many industries that if you really know sectors well, I think it's a big opportunity, because you're going to have to, for a lot of deals, you're going to have to really think about the industry, understand the end markets. And, you know, thankfully for us, with about 35 full-time people and over 30 operating partners, one of the things that independent sponsors like is that we can often help them build their team, build their boards, bring customers in, and really be quite strategic to them. And where that helps for deploying capital is outside of the obvious, I guess, in a market like this, where that's helping us, Drew, is that industries we know well, with management teams that we already have relationships with. Some of my partners that ran, you know, Merrill's $6 billion RP business 30 years ago, or my partner Brian Finn, that was the president of Credit Suisse. Thankfully, we have a big Rolodex of people that we know well. And so there's a deal that I think we'll sign up shortly. For example, it's with a management team that we have met before. We do know we're not doing the current in-persons. We're doing video, but that's a supplement to prior in-person meetings. So we're fortunate to have a pipeline that includes industries we know well and business owners that we already know at least reasonably in person and have some tenure with. As far as meeting somebody new that we really have never met before and don't have a relationship, I think that would be really tough for us. We so far haven't tried to push something like that towards the goal line. And I think just like Chris mentioned, you know, we do a lot more volume, but relationships still really matter to us. Who we're doing business with, when there's challenges, which happen, right? It all looks like this in the business plan, but we all know the realities of it, right? And we want people to work through challenges and opportunities with together and make sure there's a good cultural fit that way. So I don't think we could close a deal where we don't have relationships, but if we have prior relationships, you know, we are moving forward with those. And we're also, I would say, from a team's perspective, I like getting a pulse on the market a little bit. What I would share as far as our pulse within our team is that I'm willing to get in a car and go somewhere, and as are a lot of the members of our team. And thankfully, we have people in about 20 cities across the country, so we can do pretty good coverage. We're not willing to get on airplanes right now, but we are willing to get in a car and go somewhere and not shake hands, as Frank mentioned, but probably get better at bowing and, you know, break bread across a 6-foot table and things like that. You know, we are now starting to be willing to do things like that, and that's a new evolution over the past week or so.
You know, Brett, it's a really good point, because I was talking with a client the other day about that exact travel issue, and they said basically if they have their team, they're flying private because they do want to get out there and meet. You know, it's not enough to do this by video. So I think you're going to see a lot, although it's a lot more expensive. If the deal, you know, really makes sense, or if people really want to get out there, they're going to spend a little extra money to fly the team out there. It's still social distance. But Joe and I have an expression. We say, if the why is real, so is the deal. So you don't necessarily, it'll be interesting to see if groups are doing more deals, or it's just the old fashioned way. You've got to have some ability to really look somebody in the face and get comfortable this is somebody you want to partner with. So.
All right, Frank, you want to ask the next one? Well,
you know, just sticking on this, you know, before we get into some of the way that we're seeing LOIs and documents change, we briefly, you know, touched on what kind of industries are you guys seeing that you just won't even touch now, or are you taking the approach that maybe this is I say not the new normal, but the abnormal, and things are going to come back. So that's actually creating more opportunities with certain industries. You know, somebody gave the example that I can't remember if it was Chris, that, there's a company that had 6 million in EBITDA last year, 0 today, 8 tomorrow. I mean, do you look at those companies, or, is forward, trailing 12 month no longer a thing of the past? Is it forward? Can you rely on those kind of projections? So, how are you guys approaching certain industries that were very much in favor, and now with the pandemic in the new world, do you still approach them? Airlines obviously is an example. A lot of people just getting out of airlines, but that hopefully will come back one day. What are your thoughts on industry specific?
In our point of view, more than ever, previous performance is not indicative of future performance, obviously. So we see a lot of discussions about, are we going to do like an EBITDA C with excluding COVID kind of performance as well, or adjusting to it. We think we need a little bit more time to see how things are going to adapt. So we are definitely looking at companies that haven't been affected as strongly and that have a sustainable business. Again, we don't think previous performance is indicative of what may come. We hear a lot about the swoosh, the V-shape, the W. We really don't know what's going to happen, so we're just taking a very cautious approach. In terms of industries, again, just businesses that have been sustainable. We have a couple of portfolio companies that have been, surprisingly benefited from the whole situation. Others have been a little bit impacted. So that gives us pretty good benchmarks on where we should be looking. But we're just going to be way more cautious.
Also, when you gentlemen are answering this question, talk about how you are looking at pricing deals, because that's obviously one of the biggest issues. Is somebody's coming to you, my company's historically done for 30 years X, Y, and Z. How are you going to price deals going forward? I mean, that's a huge question.
Yeah, we tried to address that. We always try to address that a little bit. Of course, we always tell our investors that we're generating good risk-adjusted returns, but how do you really measure that? And when you have multiple pockets of capital, how you can invest, it creates a good opportunity, but a challenge of saying, well, where does it fit and does it fit? And so we've tried to come up with a new matrix around relative value that we're really scoring all of our deals on, as far as thinking about where pricing should be and thinking about that from a market perspective. So from an industry perspective, I think the hardest ones that we've historically done some investing in are leisure type of things that it's hard to know. We've stayed away from restaurants because I think just generally the challenge is there, and that's I think fortunate for us. But there's other businesses that have historically been very recession resilient that you just don't know in a social distancing. So like electric go-karts, thankfully there's a bit of natural social distancing there. So hopefully there's some good go-karting enthusiasts here. It's a lot of fun. But how quickly will that come back? Time will tell. I think restaurants will be very difficult to think about in general. I think things in and around event businesses will be difficult, and just how comfortable are people going to get and how quickly will they get comfortable prior to a really clearly efficient vaccine. And that right now is really anybody's guess. There's a lot of theories out there, of course, but it's not soon. And whether we have a W around COVID, where there's another outbreak, you can see enough data now where certain states have started to reopen. And even though the governments have allowed them to reopen, it's not been like people are like, all right, let's get in the bars and let's get back to what it used to be. It's actually a pretty slow reopening. I think some of the industries that will present opportunities for a positive side that have been very COVID impacted, where we invest a lot, is the education space, for example, right? If you think about preschool chains, things like that, kids need to get back to school. Maybe there will be smaller class sizes and things like that to adapt around, viruses. But I think that's an industry that will come back and some of those type of sectors that's more clear that there's a lot of natural pressure to come back because there's a need for it, versus the sort of nice to have things that in a booming economy that we came out of were growing well. I think some of them might be in trouble for a long time. I know that the pricing specifically, but we look at every deal a bit differently. Drew probably has good pricing views, which of course should be lower than we'd all like to be.
Absolutely. Yeah. No, I think it's a good point. I think from a pricing perspective, we haven't really in the past 8 weeks seen a ton of valuation change yet, because I think a lot of companies, because we're coming out of such a robust economy, as Joe pointed out at the beginning, I mean, many of us had the best Q1 we've ever had. And so, a lot of people had backlogs that they were working through, other than the retail spaces that went to zero overnight. I mean, that there's a certain quarter of the economy that just, zeroed out, bottomed overnight, and there's no way to prepare for that. There's not a playbook for it other than starting a company from scratch. But a lot of other companies, whether it was manufacturing, if you look at what's happened here, we didn't take most recessions. There's a demand issue that slowly happens over time, and then that slowly reduces supply. Well, we shut the supply off in some cases, or it's a little bit reversed. We shut stuff down, but there was still demand. There was still backlog that people were working through. So a lot of people, March, were still working through a lot of backlog. Even a lot of companies into April, still had backlog. So I think, May and June is really where we're going to begin to see what does that pipeline look like, and what orders were put on pause that were in place previously or have not panned out. So, as we think about deals going forward, we're really, the 2 deals that I mentioned that we're about to really be working on hot and heavy, one of the things we're working with them on is, what can we monitor on a weekly basis or an every 2-week basis, as opposed to just, how are last month's numbers and did they come in where we think? Because I think that people are going to be a lot more scrupulous into what are the things that we can take a look at that are managing pipe or kind of, putting a lever on or getting a beat on how are the companies doing? How are they performing? How's that going to impact revenue? Even if it's not the financials, but what are the KPIs that influence revenue that we can begin to look at on a micro scale within the companies? So, I do think that it's going to elongate for the short term until, to Brett's point, until there's some type of vaccine and consumer confidence can really come back. I don't think we're going to see a big shift in consumer confidence. I think people are going to continue to be cautious.
Hey, Brett, while we have you, Drew, while we have you, can I ask you one? This is a question came in live over the Q&A. It said, can you speak to what's going on in some of the hot sectors, multiples, leverage deal levels, deal flow? For example, DSOs were very hot with 10 to 14x multiples, and now will be faced with higher costs, labor and PPE, lower margins, and less patience. What do you think about that?
Let's see. That's a good question. I think some of it is still a little bit early to tell. I think the natural reaction is going to be that valuations are going to come down. Again, I think a lot of people were still banking on and trying to, not knowing how long this whole thing is going to last from a macro perspective. I think people have been holding on to, we had such a great year in 19. We had a great Q1 with the hopes that, this thing was going to stop overnight. And I think as this thing has drug out, the reality is the impact is going to be far deeper than any of us would have wanted or would have liked to anticipate or admit maybe. But I think the reality of that is starting to set in. So my anticipation is naturally valuations are going to come down. How much it's kind of, at this point, I think we're still kind of early. Again, from our perspective, we're just now starting to begin to come back into the market or see new deals kind of coming into the market. So I think we're still, 4-6 weeks out of fully kind of getting a view on that. I don't know. I'm curious if anybody else has another take.
Chris, you're on mute.
Bill Overbay asked this question, I think, about DSOs, and I was actually going to raise that point because we saw a dental deal recently, and we've done a few dental deals in our past, and as of February, it was a great business, right? And now their world has completely changed. I have a couple good friends that are dentists, and near term, yes, they're doing kind of emergency procedures only, but longer term, near to longer term, they've had to order all sorts of PPE and face shields and everything. Their business is changing. And again, until there's a vaccine where everyone's completely comfortable, their business is, I think, got to be slow for kind of indefinitely. So, that will certainly impact EBITDA meaningfully, but it's got to drag down a multiple too.
Yeah, I was just on the phone with a major dental group yesterday. They're going to go through a restructure. Their PE sponsor is going to have to put in a significant amount of money to satisfy the bank. You're going to continue to see those kind of industries just hit hard, by the environment. A good friend of mine also called me. He's got another big practice, and he hasn't seen a patient in 2 months. So, are people going to start to go back? Probably. I mean, they're going to get their hair cut. God bless them. Although Stefan does it himself, does a pretty good job. But we'll see. As Cuomo said, I'd like to see that haircut social distance from 6 feet. Look, people have different tolerances of fear and risk. But most people in that industry, based on what I've been talking to, are saying, well, it's going to be a long time before we come back.
Maybe we could just, before we talk all the doomsday and what's not working, maybe we talk a little bit about some good news stories. I know from our standpoint, we closed a healthcare IT deal last week. We're about to actually close a sell-side M&A deal next week. That's a technology-oriented company. So deals are still happening. Good deals are still going on. Anyone want to talk about either sectors they think are particularly interesting or hot, or sort of good news deal stories that they think are going on?
Oh, it's all doom and gloom, Joe.
I don't have the sector we're looking at.
Perhaps we can talk a little bit about the companies we have that are doing well. We have a company in the aerospace industry. Basically, most of what they do is they park aircraft, and so you can imagine right now they used to have 100 planes parked. Now they have close to 700. You can't just park an aircraft. You have to park it and service it, and there's many things you have to do to it. So that's one of the, I guess, few of the aerospace companies that are doing well. We're fortunate to be in that business. We have another company that manufactures power supplies, mostly for military and medical industry. So they've been doing a lot of the power supplies for the ventilators and respirators. So that company has been doing very well. And then other businesses, like, for example, we have a recycling business. That one has been, doing very well. They keep on, people still generate trash every single day, so they have to go to people's homes and recycle those contents. So again, as I mentioned earlier, we're probably going to look inward at our portfolio and see what is working there, and we know those industries very well. And probably some of the companies that we'll take a closer look at are industries we know are working well and can be resistant and resilient, and those are probably the industries we'll be looking at.
Some of the sectors, video conferencing is one that is reasonably obvious that we've got a pretty big position in. Telehealth, relatively obvious. I think some of in education, including virtual education, not just your thinking of preschool and things like that, but thinking of education around truck drivers. There's a whole bunch of different things as the economy is shifting and how people consume products in particular. And then in general, the trends towards digital, we've made a lot of investments in that space in general, and technology. I think that's going to continue. I think society will be at least a little bit changed for quite a while, and the way we consume information, the way people advertise, the way people buy things. If you think about all those trends that have generally been trends over time, they're not new trends, but I think they're accelerated. I think there's opportunities there, and probably, unfortunately, for a lot of industries, some challenges there. And then there's some basic, boring type of localized businesses. Stefan mentioned some, but you have, we've done a lot of things in the summer and winter landscaping businesses, especially around commercial landscaping. I grew up in Canada, so it's easy for me to appreciate that if you have ice and snow, especially in America where people love to sue, that you've got to get rid of that. But in the summer, it's interesting that especially on a commercial level, people really want that facade to look good, because in a downturn, customers are critical and they don't want to lose any customer. And so there's some industries like that aren't fast growth, but they're very sort of limp along with GDP type of businesses that I think will continue to be reasonable investments.
What about on the PPE space? We're seeing, a number of clients have pivoted. New industries new companies are evolving. This is the new normal in the sense of PPE going forward. Are you guys looking specifically at any of those kind of companies, or do you think that it's a short run?
Can you clarify a little bit for me, Frank, what PPE companies are companies that'll receive PPE?
No, manufacturing, protective gear, whether it's face masks or, as you mentioned, respirators or sanitizer, or new products that people are just going to want to have
relative to the virus.
Yeah,
I think there are some trends. So we've got a reasonable sized video doorbell business that has heat sensors and things like that embedded into it, and then a lot of different IP and who's at your door and why, and are they approved and not, both for residential and commercial end uses. And there's some evolution going on with products there as a result of the virus, again, particularly around heat, which tends to be an indicator of the coronavirus as one, or flus and things like that, pneumonia. So I think there's opportunities there. I think there's probably we've seen some deals recently that I wonder how they'll go, where people are taking advantage of some short-term spikes in demand that are consumer products. And I kind of scratch my head and say, well, Amazon, especially with owning Whole Foods, right? They manufacture their own white label products, a lot of them. And if it's basic stuff that they can make cheaper, market easier, and distribute cheaper and more efficiently, long term, can you really compete with them? So I think there's right now some people are rushing into some things that have some short term, almost counter-cyclical, I guess, things that I would guess are going to be tough to make sense longer term. Just to think about where there's some things that are trending positive now that may not necessarily longer term.
Hey, before we wrap up, can I ask one last question? Maybe because we have a lot of independent sponsors in the room. Maybe Chris, this is for you, which is, historically independent sponsors got a bad rap because, they couldn't necessarily close deals in the way that a strategic or a committed fund could. And then the past few years, we've seen independent sponsors being able to, get deals and beat out, in some cases, traditional buyers. What do you think in this market with, private equity firms walking from deals and strategics sort of focused on themselves? Do you think there's an opportunity here for independent sponsors to sort of get in there and be able to close deals in a different way?
Our view is that we need to be, it's funny, we were talking about kind of what industries are attractive and if there's ones we're going to be targeting, and it's tough for us as independent sponsors to be, really thesis driven and to try to kind of take advantage of what, trends might be, because, at least from where our philosophy is that we need to be value added investors, which means we're going to invest in businesses that where we've got some specific firsthand industry experience, and or we're bringing an executive to the table who's got some great experience that can be helpful to the company. So if we don't check one of those two boxes, it doesn't really make, there's no good reason, frankly, for us to be involved in the deal, because we're not necessarily going to be bringing anything truly unique to the table. So we're going to continue down that path and just try to be kind of opportunistic and find businesses that are good fits with us. and hopefully get to those deals before some private equity firm might who might have some other kind of complementary or competitive experience. So I don't know that the world from that perspective really it changes a whole heck of a lot for us in terms of our approach. It's still trying to find a business where we can help them grow, and it's not a lot more complicated than that for us.
Great. I think Lena's going to give us the hook in a minute and probably wants us to wrap up.
I am. Yeah,
Okay.
I think we need to wrap, guys.
Good. So let me just say, on behalf of Frank and myself, and as the host here from Levinson, I want to thank this terrific panel. Appreciate everyone's input. Appreciate the questions from Q&A. Sorry we couldn't get to all of them, but I think we're all hoping that better days are out there and that we can keep doing deals, and that swoosh is what we get to and not a W. So thanks, everybody.
Thank you, Joe and Frank, for
Thank
leading
you.
the discussion, and thank you to our panelists. As you guys can see on the screen, we have a few more webinars coming up this week, specifically one on Thursday around healthcare services and M&A, so tune in and look out for information on that. If you guys are participating in the Deal Connect, you're going to want to log out of this meeting now and log into the other link that was attached in your brochures. If you're having any issues, please reach out to myself or anyone else on the team. But again, thank you, gentlemen, for a great discussion, and to our sponsors, of course. We'll see you all next time.
All right. Thank you.
Thanks, everyone.
Thank you.
Thanks, everybody.